Hey traders, and welcome back to another episode of Smart Risk. If you don't know how the market really operates behind the scenes, becoming a profitable trader is just a dream. The secret? It all comes down to one thing: liquidity. In this video, I'm going to break down exactly how to decode market direction using liquidity concepts in the simplest and most mechanical way possible, so you can protect your capital and predict where price is headed next with confidence. Think of this like getting a real roadmap to how the market moves. Once you understand this, your entire approach to trading could change forever. So, don't skip a second. This is the kind of video that can transform your trading skills in ways you never imagined. We always appreciate your support, so please give this video a thumbs up and subscribe to our channel if you are new. See you after intro.
I don't ever slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up.
Welcome back traders. So, let's get started. The very first thing my eyes lock onto when I open a chart is external liquidity. Why? Because spotting the most recent external range liquidity gives me a major edge in predicting the market's next move, before it even happens. So, what exactly is external liquidity? It's the liquidity sitting outside the current trading range, typically found above key swing highs or below major swing lows, and it shows up as either buy-side or sell-side liquidity. Let's quickly break down what we mean by buy-side and sell-side liquidity. Starting with buy-side liquidity. Buy-side liquidity refers to the all liquidity areas above the current market's price. For example, take a look at this swing high right here. It's loaded. Why? Because that's where early sellers have their stop losses, and breakout traders have stacked their buy-stop orders, all waiting to get triggered if price pushes above. When price reaches that level, buy stops get triggered, stop losses get hit, and suddenly there's a surge of buy orders flooding in. And guess who's waiting there? Exactly. Institutions, ready to offload their sell orders at premium prices. That's how smart money uses buy-side liquidity zones. Not to buy, but to sell into the hype. Now let's flip it. What's sell-side liquidity? It's the exact opposite of what we just covered. Sell-side liquidity sits below the current market price, and it includes both external and internal liquidity zones. For example, look at this fair value gap sitting under price. That's a sell-side liquidity zone. It shows imbalance, inefficiency, and a liquidity void. Basically an open invitation for price to come down and rebalance it. Now look at this swing low at the bottom. This is where stop losses from long trades and pending sell stop orders tend to pile up. So what happens when price drops into these zones? That's right. Sell orders get triggered, creating a wave of selling pressure. And while most retail traders panic or get trapped, smart money steps in and buys at a discount using that fresh liquidity. Understanding buy-side and sell-side liquidity is a game changer. It shows us exactly where the big players are hunting for orders, and how they move the market in their favor. Now let's get back to our main topic. External liquidity is like one side of a magnet, but a magnet needs two poles. The other side, that's internal liquidity. The market builds up internal liquidity, and just like magnetic force, it gets pulled toward the external. That attraction creates the momentum the market needs to make its next big move. So, what exactly is internal liquidity? Internal liquidity is found inside the current trading range, where most of the action is happening. Orders are being filled, traps are being set, and volume is actively shifting. It typically shows up in the form of fair value gaps and volume imbalances. But it can also include order blocks and even trend lines depending on how price interacts with them. Take a look at this example. These highs and lows? That's external liquidity, the juicy stop hunt sitting outside the range. But these fair value gaps inside the range? That's your internal liquidity, where price keeps rebalancing and institutions quietly fill orders. Now here's the big picture. Internal and external liquidity together form the market's dynamic liquidity. This is the real engine that drives the price, pushing it up, dragging it down, or faking you out. Imagine the market like a loop. Price is always rotating between internal and external liquidity. It's either moving from a high or low toward a fair value gap, or from a fair value gap toward a high or low. That's the core rhythm of price movement. Once you understand that, you start trading with the market, not against it. Let's break this down with a real market example. Price starts off with a strong upward rally, aggressively pushing toward external liquidity, which in this case sits just above a previous swing high. As it reaches that level, boom, it sweeps the liquidity. That means all the stop losses and buy stops sitting above that high get triggered, fueling the move. But here's the twist. Once that external liquidity is taken out, the market doesn't just keep going up forever, it pulls back, and where does it go? Right back into a fair value gap that was left behind during the rapid move up. This is the market rebalancing itself, addressing internal liquidity. Now that the imbalance is filled and internal liquidity is addressed, price looks outward again, seeking for the next external liquidity target. Maybe it's another swing high, maybe a key resistance level. Either way, price heads up again and sweeps that next zone. After the sweep, price drops again, revisiting the new fair value gaps that formed during the second rally. It's a full cycle. Sweep external, rebalance internal, repeat. That's the natural rhythm of the smart money market structure. And once you learn to spot it, you'll stop chasing price and start trading with intention. Now here comes the real challenge. How do we predict where price is heading next? Will it move up to sweep the upper external liquidity, or drop down to grab the lower external liquidity? But before we continue, if you're looking for a trading platform that lets you trade Forex, crypto, and stocks all in one place, you should check out SimpleFX. SimpleFX is one of the top-rated trading platforms on Trustpilot and offers many great services. Its user-friendly interface works great on the web, desktop, and phone. With over 1,000 assets, great customer service, and high leverage up to 1,000, it offers many unique features. On top of that, SimpleFX offers a deposit bonus of up to $5,000, depending on how much you deposit. If that sounds good to you, check the link in the description. To answer that, there are several different approaches to consider. First, you need to assess the order flow. And here's where things get interesting. Start by zooming out and looking at the higher time frame structure. Or, if you're staying on the same time frame, just check the recent order flow direction. For example, if price has been in a downtrend, odds are high it'll continue lower, breaking structures to the downside and hunting that sell-side liquidity beneath recent lows. But if price has been trending up, your expectation should flip. Price is likely headed toward the external liquidity sitting above those highs. Reading order flow is like getting a sneak peek at the market's next move. The next, and arguably more important approach to predicting the market's direction, is to see how price behaves once it enters the fair value gap. If price respects the fair value gap and shows signs of rejection to the upside, it suggests that price is likely aiming for upper external liquidity. On the other hand, if price disrespects the fair value gap, meaning it breaks right through it, without any meaningful reaction, that gap flips its role. It becomes what we call an inverse fair value gap, acting more like a resistance zone now. When that happens, it signals a higher probability that price will move downward, targeting the external liquidity resting below the most recent low. Let's quickly recap the concept of the inverse fair value gap, so you know exactly how to take advantage of it in situations like this. Whenever price breaks straight through a key demand or supply zone without any respect, that zone flips its role. In other words, a supply zone turns into a demand zone, and a demand zone flips into a supply zone. The same transformation applies to fair value gaps too. For example, when price breaks right through a bullish fair value gap without showing any respect or reaction, that gap flips its role and becomes an inversed fair value gap. Now, instead of acting as support, it's more likely to hold as resistance. So what exactly is an inversed fair value gap? It forms when price disrespects a regular FVG, meaning instead of reacting to it, price violates it by breaking and closing straight through it. When that happens, the original FVG switches its role and often acts as a new resistance or support zone, depending on which direction price breaks out. For better understanding, if you look at this example, We have a bearish fair value gap that price breaks through with these two bullish candles, creating an inversed fair value gap. Now, what we expect here is for the price to either retrace into this zone or continue moving higher. If we play out the chart, you can see that the price retraces back into the inversed fair value gap, respects the consequent encroachment, and then continues higher. This example clearly shows how fair value gaps switch their characteristics in various scenarios, acting as a support zone for the price's next uptrend movement. Now, if you're wondering, is there any way to tell if price is more likely to respect a fair value gap or just blow right through it? The answer is yes. By closely watching how price behaves inside the gap, you can get valuable clues about what's likely to happen next. Let's get it crystal clear. Inside every fair value gap, there are three key levels you should pay attention to: the premium high, the discount low, and the midpoint, also known as the consequent encroachment. Now, you might ask, which of these matters the most? It's the consequent encroachment, the 50% midpoint of the fair value gap. If price returns to this level and respects it, that's a strong signal that the market may continue in its original direction. But if price breaks through the midpoint without any sign of rejection, it's often a clue that the original imbalance has failed, and price may be headed in the opposite direction. Now let's circle back to our main topic. So, in this scenario, if price enters the fair value gap and shows rejection from the midpoint, also known as the consequent encroachment, that signals a high probability that price will bounce back up after tapping the 50% level of the gap. Once the fair value gap is filled and the internal liquidity within the current trading range has been addressed, there's a strong chance the market is now ready to expand outward, with price likely aiming for the external liquidity resting above the most recent high. Conversely, if price enters the fair value gap but violates the midpoint without showing any rejection, that's often a strong sign the market intends to break through the gap, flipping it into an inverse fair value gap. This newly formed inverse gap is now likely to act as a resistance zone going forward. Once internal liquidity has been addressed and a bearish inverse fair value gap is in place, it becomes a powerful confirmation that price is preparing to target external liquidity to the downside. Especially if price retraces back into the inverse gap and respects the midpoint this time by showing rejection. It strengthens the case that the market is about to continue lower, aiming to sweep the external sell-side liquidity below the most recent low. Now, what happens if we have healthy and efficient price action within our trading range, meaning there's no internal liquidity left to be addressed? How does price behave in such scenarios? As mentioned earlier, price always moves between internal and external liquidity. Think of it as a continuous loop where the market oscillates from fair value gaps and imbalances to highs and lows stacked with stop orders, and then back again. But when internal liquidity is absent, when the price action is clean, efficient, and balanced, external liquidity becomes the sole driver of price movement. For example, in a situation where there's no internal liquidity present, price begins to cycle directly between buy-side and sell-side liquidity, targeting the major highs and lows where stop orders are likely to accumulate. So, in a case like this, when buy-side liquidity is cleared, whether through a sweep, stop hunt, or manipulation, price often reverses direction and moves towards sell-side liquidity, below a key low. Then, after sweeping that low, the market might again shift downward to take out a recent high. This back and forth continues until a new inefficiency or internal liquidity forms, which would then reintroduce internal liquidity into the equation, restoring the full liquidity cycle. That's it, traders. Thanks for watching. I hope you found this video valuable. If you did, hit subscribe and turn on notifications so you never miss an update. Drop a comment below with your thoughts or topics you'd like to see next. Your support means the world to us. See you in the next video.